Usually when we talk about manufacturing, we tend to picture like automated assembly lines.
Right, yeah. Lots of robots.
Exactly. Cars rolling off a conveyor belt or, smartphones just snapping together in seconds with all this robotic precision. It's an environment that's totally optimized for speed and volume.
Absolutely. High volume, low margin of error.
But what happens when the product you are building is essentially a floating city?
Oh, man.
Yeah.
That changes everything.
Right. Something that takes a decade just to conceptualize requires tens of thousands of specialized artisans and serves as a cornerstone of global security.
Well, I mean, it completely rewrites the mathematical realities of running a business. You're no longer managing an assembly line at that point.
No, I'm taking that.
You're managing this sprawling multi-year industrial ecosystem where, weather, geopolitical shifts, and macroeconomics, they all crash into your balance sheet simultaneously.
It's wild. Welcome to the Deep Dive, everyone. Today, we are looking at what I think is the ultimate industrial paradox. We've got the Q1 2026 earnings data from Huntington Ingalls Industries, or HII.
The biggest of the big.
Yeah, they are the largest military sea power provider in the United States. And the reason we're poring over their May 5th press release and earnings slides today is because they are navigating this really incredible tension.
It really is fascinating.
Our mission today is to decode how they do this, because they're sitting on this staggering backlog of orders. They're building the most complex warships in human history, and yet they are fighting tooth and nail just to maintain a baseline profit margin.
Yeah, and even if you aren't a defense analyst, this quarterly report from HII is just a masterclass in heavy industrial management.
Totally.
I mean, it offers this really rare, transparent window into workforce dynamics, supply chain fragility, and just the raw economic mechanics of building modern defense infrastructure in 2026.
Okay, let's unpack this tension right away. The top-line growth is honestly the first thing that jumps off the page, but I want to look under the hood here. What are the core financial realities for HII in this first quarter?
So the top-line figures show a company operating at just an unparalleled scale. They generated $3.1 billion in total revenue for Q1 2026.
Which is huge.
Yeah, it represents a 13.4% increase year over year. Net earnings held perfectly steady, right at $149 million, translating to about $3.79 per diluted share.
Okay, solid numbers.
Right. But the figure that defines every waking moment for HII's executive team is their backlog.
Ah, the backlog.
Yes. As of the end of March 2026, their order backlog sits at a mind-bending $54 billion.
$54 billion, and that includes $4.0 billion in brand new contract awards booked just in this first quarter alone.
That is, it is difficult to even visualize that amount of capital locked up in future work.
It really is. And a backlog of that magnitude is this fascinating double-edged sword. On one hand, it offers incredible long-term visibility, right? They know what they're doing for the next decade.
Exactly. They know exactly what their shipyards will be building well into the 2030s, which is a structural luxury most global businesses can, only dream of.
Sure.
But on the flip side, it creates immense compounding pressure. Having the orders means nothing if your kitchen can't cook fast enough, to use a restaurant analogy. If you can't physically build the ships, the backlog just sits there.
It's like having an exclusive restaurant with a line wrapped around the block. Great for business, but a nightmare for the chefs.
Yeah.
And actually, I noticed a glaring discrepancy when looking at the margins.
Oh, yeah. The margin compression.
Yeah. With top-line revenue growing over 13% to reach that $3.1 billion mark, the overall operating margin actually shrank. It was 5.9% in Q1 of 2025, and it fell to 5.0% this quarter.
Right.
From a pure business mechanics standpoint, if a company is increasing its volume of output, shouldn't their profit margins be expanding, through economies of scale? Why are they scaling up revenue but actually keeping less of every dollar?
Well, the sources address this dynamic directly, and it really comes down to the insidious nature of long-term defense contracting in an inflationary environment. HII is very transparent that they are heavily burdened by what they call pre-COVID challenged contracts.
Pre-COVID, so the economic ghosts of 2020 are still haunting the shipyards.
They absolutely are. Consider the mechanics of how these ships are purchased. You have contracts for submarines or aircraft carriers signed back in 2018 or 2019.
Okay.
And those had very specific fixed cost assumptions baked into them. They modeled out what a spool of maritime-grade copper wire would cost in 2024.
Oh, wow.
Yeah, they modeled the hourly rate for a master welder, and then the entire global economy shifted. Inflation spiked, supply chains fractured, and labor markets tightened severely.
So they're stuck.
Exactly. So HII is currently building ships using 2026 labor and material costs, but getting paid based on 2019 pricing assumptions.
Geez, that structural squeeze makes a 5% margin look like a minor miracle, honestly.
It really does. And the CEO's stated priority right now is entirely focused on throughput, getting the ships out the door.
Accelerating the physical movement of these older vessels through the yards.
Yes. The goal is to just flush those pre-COVID contracts out of the backlog so they can transition to the new post-COVID contracts. Those newer agreements, they have a much more balanced risk equation. The margins on those are expected to be much closer to historical norms.
But flushing those older vessels out of the backlog is, well, it's easier said than done when a single vessel weighs 100,000 tons.
Just a bit, yeah.
So to understand how they are actually cooking all those meals in that $54 billion order book, we really need to look inside the physical shipyards. The heady industry side of the house is split into two sprawling complexes.
Right, the big two.
Let's start with the largest one, Newport News Shipbuilding.
So Newport News is the primary driver of their heavy manufacturing revenue. They brought in $1.665 billion in revenue for the quarter.
Which is a 19.3% jump.
Exactly. And the data indicates this volume increase was driven by higher activity across aircraft carriers, submarines, and naval nuclear support services.
They noted a specific milestone for Newport News in the report, too, completing builder sea trials for the aircraft carrier John F. Kennedy, designated CBN 79.
Right.
And for a casual observer, a sea trial might sound like, routine test drive. But in the context of an aircraft carrier, the physical reality of that is staggering.
Oh, it's massive.
This is the moment a floating nuclear-powered city tests its propulsion, its radar arrays, its flight deck systems in open water for the very first time. It requires coordinating thousands of sailors and engineers to stress test systems that have only existed on paper or in dry dock up until that exact moment.
It is an absolute monumental feat of systems integration. And moving down the coast, their other major physical hub is Ingalls Shipbuilding. Ingalls pulled in $725 million, which is an increase of 13.8%, and that's heavily driven by volume in their surface combatant programs.
Right, and the major milestones at Ingalls were builder sea trials for the USS Zumwalt, the DDG-1000 destroyer, and authenticating the keel of the amphibious transport dock Philadelphia, the LPD-32.
Yes, the keel authentication.
Which is another one of those terms that sounds ceremonial, but it represents a major financial and physical inflection point.
Definitely.
It traditionally involves, like, welding the ship sponsor's initials into a steel plate. But from an engineering standpoint, it means the modular foundation of the ship has been locked into place. It signals a transition from fabricating loose parts to actually assembling the macro structure of the hull.
Right, which unlocks specific milestone payments from the government.
Ah, there it is. And that
Yeah.
actually brings me back to that same margin discrepancy we talked about, but amplified at the shipyard level.
Here we go.
Yeah, here's where it gets really interesting. Newport News saw a massive 19.3% revenue jump, but their segment operating margin dropped 80 basis points, down to 5.3%. Meanwhile, Ingalls experienced a similar thing, with their margin dropping to 6.8%. If they are building more and hitting these massive physical milestones, why are they keeping less of every dollar at the specific yard level?
So, relying on the source data here, it's a combination of performance mix and accounting comparisons. At Newport News, the data points to some lower performance metrics in aircraft carrier construction.
Okay.
But a significant portion of that 80 basis point drop is actually simply a tough year-over-year comparison.
Oh, so?
Well, back in Q1 of 2025, Newport News received these specific one-time contract adjustments and performance incentives on the Virginia-class submarine program.
Oh, I see.
Yeah, those incentives artificially boosted last year's Q1 margins. So since they didn't have those same one-time bumps this quarter, the current margin just appears deflated by comparison.
So the math is comparing a baseline quarter against an artificially inflated one. Does Ingalls have a similar excuse?
For Ingalls, the margin compression is purely about the mix of work on the floor. The increased revenue from the surface combatants was a net positive, but it was offset by performance challenges and cost overruns on their amphibious assault ship.
Got it.
When you're managing multiple billion-dollar vessels simultaneously, some are naturally going to be in a more profitable phase of their life cycle than others. It's a complex mix. You're balancing the highly efficient production lines against the vessels experiencing engineering bottlenecks.
Which perfectly transitions into how they actually solve those bottlenecks.
Yeah.
Because you can have the most advanced CAD drawings and supply chain algorithms in the world, but eventually human hands have to pull the cables and weld the high-yield steel.
Exactly. It always comes back to the workforce.
And the numbers regarding their labor force are actually surprisingly optimistic. The report highlights an 18% year-over-year throughput improvement in Q1 2026.
Which is wild. I mean, an 18% improvement in how fast metal moves through a shipyard is an extraordinary operational shift. And the sources show this builds on a roughly 14% improvement they achieved in 2025. So they are systematically breaking down workflow barriers. They're hitting their 15% target.
And they outline the specific labor strategies driving this, which is cool. They ratified a new collective bargaining agreement at Ingalls that locks in labor stability all the way out to 2031.
That's huge for them.
Yeah, providing meaningful wage enhancements for the workers. Plus, between the Newport News and Ingalls apprentice schools, they graduated roughly 200 future shipbuilding professionals this quarter alone.
They're aggressively building an internal pipeline of specialized talent. But the most fascinating strategic pivot mentioned in the sources is their reliance on what they call the trusted industrial base.
Ah, yes. The outsourcing network.
Exactly. HII literally doubled their outsourced labor hours in 2025 and explicitly stated they intend to rapidly accelerate outsourcing throughout 2026.
Let's pause on that, actually. Because why would America's largest shipbuilder outsource? Like, outsourcing in defense contracting fundamentally changes the risk profile. It's almost like Apple with Foxconn.
Right.
Apple designs the silicon, they architect the software, and control the final product. But they outsource the commoditized metal stamping and glass cutting to sub-tier vendors.
That's a great analogy.
HII is basically treating the shipyard the same way. They are positioning their elite internal workforce as like master integrators, focusing entirely on the nuclear reactors, the combat systems, the classified technology. Meanwhile, they're sending the basic hull fabrication and pipe fitting out to external vendors. It's like hiring a sous chef to chop vegetables so your head chef can focus on the main course.
That's exactly what's happening. And the expansion of their new facility in Charleston, South Carolina is a direct manifestation of this strategy.
Okay.
They are utilizing contract labor and remote facilities to address these really critical gaps in their traditional shipyards. The post-COVID labor market for heavy industrial trades is incredibly shallow.
It really is.
So by outsourcing the less complex components, they preserve their highly trained in-house master welders and electricians for the critical path items. It's a calculated efficiency play.
Wait, but outsourcing to a sub-tier vendor, sure, it sounds great for preserving internal labor and expanding margins on a spreadsheet, but aren't they just trading labor bottlenecks for massive supply chain risks?
It definitely introduces risk.
Like, if a sub-tier vendor in Charleston misses a deadline on a specialized submarine module, doesn't the entire integration timeline at Newport News come to a grinding halt? You lose direct oversight of the production line.
You do, and that is the calculated gamble at the heart of the trusted industrial base. You're absolutely introducing new vectors of supply chain fragility.
Yeah.
The sources indicate HII is attempting to mitigate this by, aggressively vetting and embedding their own quality control metrics into these partner facilities. But the reality is the current labor shortage gives them almost no alternative.
Wow.
The risk of keeping all the work in-house and facing catastrophic delays because you don't have enough workers is far greater than the risk of managing a distributed network of trusted external vendors.
They just have to spread the load.
They do.
But, optimizing human welders only solves half the problem. Because modern warfare requires more than just floating metal. If a modern destroyer is essentially a floating data center, the bottleneck isn't just steel, it's software.
Oh, absolutely.
So how is HII managing the digital integration of the fleet?
Well, that brings us to their high-tech, non-traditional segment, Mission Technologies. This is their second largest segment by revenue. It generated $748 million this quarter, marking a 1.8% increase.
Okay.
Mission Technologies is the division responsible for the digital nervous system of the fleet. They handle all domain operations, unmanned systems, artificial intelligence, machine learning, and C6ISR.
Right, C6ISR.
Yeah.
That's one of those dense defense acronyms that definitely needs unpacking.
Good luck.
Yeah, it stands for Command, Control, Computers, Communications, Cyber, Intelligence, Surveillance, and Reconnaissance.
A mouthful.
It is. But functionally, it's the invisible web that allows an autonomous drone over the Pacific to instantly stream targeting data to a destroyer miles away, while simultaneously defending that entire network against hostile cyber intrusions. It is the connective tissue of modern warfare.
And HII is investing heavily to ensure they own that connective tissue. The earnings materials highlight the recent expansion of their unmanned operations facility in the United Kingdom.
Right.
And this isn't just some administrative office, you know. It provides a physical staging ground to integrate autonomous underwater vehicles and surface drones directly with the Royal Navy and broader European partner forces.
They also secured a position to compete on this massive contract, the Advanced Technology Support Program V, or ATSP-5.
Oh, yeah, the microelectronics one.
Yeah. It is a $25.4 billion contract vehicle focused on microelectronic support for the Department of Defense. This is all about securing the supply chain for the critical silicon chips that go into missiles and radar systems, bypassing vulnerable commercial supply lines.
Exactly.
So they are deeply embedded in the high-tech future. But the financials for this segment reveal another weird contradiction. I want to ask you a pointed question based on the numbers here.
Shoot.
Operating income from Mission Technologies actually dropped 12.5%, falling down to $35 million. Why the dip in the most futuristic part of the company? What does this mean for the bottom line?
So, relying on the exact source text here, we have to look at the granular disclosures. The revenue growth in all domain and unmanned systems was robust, but it was partially offset by a lull in volume within their legacy warfare systems division.
Okay.
But the specific 12.5% drop in operating income was actually driven by two distinct factors. First, they experienced lower equity income from some of their nuclear and environmental joint ventures.
Oh, I see. So the core drone and AI divisions weren't necessarily losing money. A separate joint venture just kind of dragged down the segment average.
Yes, exactly. And the second factor is entirely accounting-based.
How so?
The Mission Technologies segment absorbed roughly $18 million in the amortization of purchased intangible assets this quarter.
Oh.
Right. When you acquire tech startups or patent portfolios, you have to gradually write off the cost of those intangible assets over time. It registers as an expense that lowers your operating income on paper, but no actual cash is leaving the bank account.
Right. It's non-cash.
Exactly.
Right.
If we strip out that $18 million non-cash hit, the core operational profitability, the EBITDA margin, is actually a very healthy 7.8%.
Okay, so the underlying operational business is solid once you clear away the accounting adjustments.
Exactly.
But, building physical traditional ships, expanding operations in the UK, and scaling up microelectronics, all of this requires an immense amount of capital, which perfectly cues up a final check on HII's financial health. I want to shift our focus to the cash flow statement because there is a glaring negative number sitting on the balance sheet that might look alarming at first glance.
Yeah, the cash flow dynamics in defense contracting often run completely counter to basic business intuition.
They certainly do here. Net cash used in operating activities was $390 million, and their free cash flow was a negative $461 million for the quarter.
Right.
Wait, I have to stop you there. How should you, the listener, interpret a massive company burning through cash like that? They made $3.1 billion in revenue this quarter, but they have negative $461 million in free cash flow.
Well, this is where we have to provide the calm voice of reason and look at the broader financial health.
Please do.
It is the reality of what we call lumpy cash flow. Unlike, say, a software company that receives steady, predictable monthly subscription revenue from users, heavy industrial contracting relies on massive, sporadic milestone payments from the government.
Oh, right. So the timing of the checks rarely aligns with the timing of the bills?
That is the core of it. HII has to purchase millions of dollars worth of specialized steel, titanium, and advanced electronics up front.
Which hits the balance sheet immediately.
Exactly. If those material costs hit the balance sheet in January, but the government's milestone payment for, laying the keel doesn't arrive until August, the Q1 cash flow will appear deeply negative.
That makes total sense.
And the sources provide broader liquidity context to show the company actually remains financially robust. Because despite the negative cash flow for the quarter, HII maintains $216 million in cash on hand and a total liquidity of $1.9 billion.
Okay, so they are not in any danger of missing payroll anytime soon.
Definitely not. Furthermore, that negative cash figure actually includes heavy reinvestment. They spent $71 million on capital expenditures, physically upgrading their shipyards and tech facilities.
Right.
which represents 2.3% of their total revenues. And crucially, they still return capital to their investors, paying out a $54 million dividend.
Right, and a company facing genuine liquidity issues does not voluntarily issue a $54 million dividend.
No, they don't. They are just balancing long-term structural investments against shareholder returns while riding out the turbulent cash cycles of shipbuilding.
Well, looking ahead to 2026 and beyond, the earnings release also provides a long-term roadmap. They are projecting a top-line compound annual growth rate, or CAGR, of roughly 6%, with the stated goal of surpassing $16 billion in enterprise revenue by 2030.
It's ambitious.
Yeah. For the immediate future, their fiscal year 2026 guidance predicts between $9.7 billion and $9.9 billion in shipbuilding revenue, targeting a 5.5% to 6.5% margin. And for mission technologies, they anticipate between $3.8 and $3.2 billion.
They are mapping out steady, deliberate growth. They're just systematically grinding through the remaining pre-COVID contracts.
So, stepping back to synthesize all of this for you, HII is just an extraordinary case study. The big takeaway here is that we are watching an industrial giant attempt to bridge two entirely different eras of manufacturing.
Yeah, that's exactly it.
On one side, you have heavy traditional manufacturing. They are welding 100,000-ton steel behemoths that take a decade to finish. They're forced to overhaul their labor strategies and outsource basic fabrication just to survive a tightening labor market.
Right.
But on the other side, they are this nimble, high-tech operation rapidly scaling up unmanned drones, AI networks, and microelectronics facilities in Europe. They are managing an incredibly fragile supply chain while chewing through a $54 billion backlog that honestly eclipses the GDP of many nations.
It really is an industrial balancing act with zero margin for error. And the contrast between their two divisions leaves us with a really provocative thought to mull over.
That's that.
Well, we saw HII's aggressive expansion of their UK unmanned operations facility happening right alongside massive traditional ship trials like the Kennedy and the Zumwalt.
Right.
As the nature of global defense rapidly shifts toward AI, microelectronics, and autonomous underwater vehicles areas where HII is already the world's largest producer, the definition of naval power is changing.
So the era of relying solely on massive centralized warships is evolving.
Given HII's dual capabilities, how long will it be until the composition of that $54 billion backlog fundamentally flips?
Oh, wow.
Right. Will the shipyards of 2040 still look like sprawling steel foundries, or will they resemble pristine technology campuses, churning out thousands of autonomous interconnected drones?
That is a fascinating question.
We are witnessing the very beginning of a profound shift in industrial base power.
That is a phenomenal thought to end on, from floating cities of steel to distributed networks of autonomous intelligence. Thank you all for joining us on this deep dive into HII's Q1 2026 earnings. Keep exploring the sources, keep questioning the mechanisms behind the data, and we'll catch you next time.